Hello everyone and welcome to my lecture on Chapter 6, Cash and Internal Controls. And right now we are going to be talking about the bank reconciliation. And this is our first part in my lecture series on the bank reconciliation. And for now we're going to go over the basics of the bank reconciliation and the first few steps for how to start a bank reconciliation. So first of all, what is a bank reconciliation? A bank reconciliation is a type of internal control specifically related to the cash that a company has at the bank. This particular internal control is one that is the responsibility of the accounting department. So in general, internal controls are the responsibility of everybody. And internal controls over cash can involve, the cashier at the cash register. It can involve a bunch of different people, but this particular item is the responsibility of the accounting department. Bank reconciliations are done at the end of every month. And the purpose of them is that they make sure that the company's cash records are complete and correct, that we're not missing anything, that we didn't make any errors. And this type of internal control is helpful because it also helps to catch any errors or fraud so we can fix them quickly. And I'll show you how that works throughout the course of this lecture. Now, first of all, a company has different accounts for different types of cash. So when we think of cash, of course, we think about stuff that looks like this, right? Dollars and cents. And a lot of times companies will hold that in their cash register. And that is what we consider cash on hand. So the cash that a company has on their premises. But a company can also have cash in other places. For example, in the bank. And so we have different accounts depending on the different types of cash we're talking about. So we have an account for cash on hand, and in this account we record all the cash that came in from customers and all the cash that went out, like if we, give our customers change again. And we also keep track of the cash that we have in the bank using a separate cash account. And that cash account is going to look at both the ins and the outs as well. So the ins would be any deposits that we make to our bank statement. So when we receive cash from our customers, or if our bank, our cash register gets too full, we put that in the bank. And it's basically a transfer out of cash on hand and into the bank. And it also records the outs, whatever comes out of our bank account, and that would be things like checks. So when we write checks, those are things that come out of our bank account. So we're going to put that on the credit side because they decrease the cash. They decrease the cash that we have in our bank account. So a company can have multiple types of cash accounts, but the bank reconciliation relates only to cash in the bank. Okay, what we're trying to do is we're trying to make sure that our accounting records for what we have as cash in the bank are correct and complete. Okay, so what happens is this. Every month, the bank sends a company a bank statement, and this can be a paper bank statement or it can be electronic. And that bank statement will show everything that the bank has on record for that company, all the ins and the outs, as well as the final balance of what the company had at the bank at the end of the month. Okay. Now, the bank reconciliation is meant to compare those records of the bank to the internal GL account, the ledger that they have on their books. So we compare the deposits that we have and the checks that we have, and we look at our ending balance. And when you look at these two ending balance amounts right here, we see that they're different. Okay. Now, does this cause for panic? Like, oh my gosh, money's missing. What happened to it? Somebody must be stealing our money. What's going on? Or somebody made a mistake. Okay, not necessarily. There are a lot of different reasons why these two numbers might be different. So the purpose of the bank reconciliation is to look at all of the reasons why, the things that make up this difference, and determine if these reasons are okay, they're just timing differences, or if there was an error or fraud that we need to correct or address. Okay, so the first step in a bank reconciliation, there are, of course, a number of steps, but the first one that we're going to look at is step one is, first of all, to enter the ending balances from the bank and from the book. Okay, that's kind of our starting point, is let's look at what the total difference is. So if we look at this example that I've given you, we've got the bank statement on the green side, and we've got our books, our accounting records on the blue side. And we see that here is our ending balance on our bank statement, ending balance on May 31st. And here we have our accounting records, and this is our ending balance in our GL account right here. And we see these two amounts are different. Okay, so the first thing we have to do, that's our starting point. So when we come over to our bank reconciliation template, which is right here, we look and we see that there are two sides to the bank reconciliation. There's the bank side on the left and the book side on the right. Okay, so we're going to start out just by putting in the ending balances to figure out what the total difference is. So on the bank side, this is our bank ending balance. So we're going to put that amount right here as our bank balance. So I'm going to go ahead and input that amount of 22543.70. And then we also have the book balance. That was the detail in our ledger. And we're going to put the book balance here on the book side. So I will enter in 17384.2. Okay, that is our starting point. All right, so that is done. We have entered in our ending balances. We know what the total difference is. Now what we have to do is identify all of the things that make up that difference. Now, the problems that are given to you in the book tell you what the differences are. They just describe them for you. They don't make you actually look for them. But I wanted you guys to get the experience of what a real accountant goes through when they're going through the bank reconciliation. A real accountant has to find the differences for themselves. So I wanted you to get the experience of what that process is. And you'll see that here, okay, with this example. They look at an actual bank statement, and they look at the actual accounting records, and they look at every detailed item. They look at every single check, and they look at every single deposit. Okay, and they match them up one for one with what the book says are the deposits, and what the bank says are the checks and the debits. So we look at each of those things individually, and from there we're able to identify the differences. So what I have done here is I've highlighted the differences that I found. There were 7 differences. Hopefully you can go through that process and find them yourself as well. But that basically tells us that these are all of the differences that make up the difference between these two bank and book balances. So now that we have figured out the total difference in step 1, and we've identified the individual differences, next we're going to talk about what we do with those differences and where they belong on the bank reconciliation. So stay tuned for the next video in the series to explain all of that.